In 2024, if there was anything difficult across was pitching any other form of investment vehicle against the money market funds when they were giving returns of high as 18, 16, 17%. Money market funds have remained the in thing in investing for majority of the investing public for year 2024. But the last quarter has given us an opportunity to present the close difference and similarity between money market funds and fixed income funds, which are better known as bond funds by some fund managers, and particularly Britham's fixed income fund, which they call a Britham Bond Plus. The two investment vehicles, that is the money market funds and the fixed income funds or the bond funds, are so similar in their asset allocations and purposes that you may be forgiven for thinking that these two investment vehicles have nothing in difference. And for that reason, it's also demonstrated by the number of fund managers who have divorced their money market funds in favor of fixed funds as compared to the majority of fund managers operating money market funds without fixed income funds options. They are only, in the schedule that we are analyzing, we only have 9 fixed income funds as compared to over 38 money market funds. We will take a keen, closer look on the fixed income funds, comparing them with the corresponding money market funds that are run by the same fund managers. Because comparing a fixed income fund by one fund manager to a money market fund operated by a different fund manager may not give us a clear insight into the differences and similarities of the two investment vehicles, and possibly a look into when and why one would opt to have either the two forms of vehicles, a money market fund on one side and a fixed income fund on the other side, or choose a fixed income fund at a time like this one. We are witnessing a closing in the gap or the difference, marginal difference between the returns that were high returns that were posted by the money market funds and what is now being given by the fixed income fund, because as the market interest rates have been coming down from highs of 18% at the beginning of 2024 to as low as 9.9% posted by the Treasury bill auctions in December 2024, the money market funds have also plummeted in their returns from as high as of 18%, and we are now having the highest return from the money market fund at 16%. That said, we need to look at the close relationship of the money market funds or similarity between the money market funds and the fixed income funds by looking at the asset allocations, which are the allowed assets to which the fund managers invest both in the money market funds and the fixed income funds. And if we go by this schedule that we have prepared, there is something that you're able to identify that these two forms of investment vehicles are more or less the same by virtue of the asset classes or the permitted asset classes that the fund managers should invest into. The first ones are the calls and fixed deposits. Don't care about the difference in naming, that in the money market funds we are calling them bank call and fixed deposits. On the other side we are calling them cash and bank deposits. They are just one and the same thing. If we look at the second one, we are talking about treasury bills, which are the same. And treasury bills, important to note is that these are short-term instruments which are given by the government. And on the second one, we have a clear difference, and we have highlighted that differentiating item in capital or in uppercase on the side of the money market funds. When it comes to treasury bonds, money market funds only take up short-term treasury bonds, And on the other side of the fixed income fund, we are taking up the entirety. All treasury bonds can be invested into when it comes to the bond funds. And that is very important. Then we have corporate bonds, we have commercial papers, and we have collective investment schemes. So the key differentiating item at that point is that money market funds are strictly invested in short-term instruments. And to be precise, the fund managers are limited to a maximum horizon of 18 months. They cannot invest in instruments that are maturing beyond a period of 18 months. While on the side of the fixed income funds, the fund managers can take up any instrument. They are not limited as to the scope and the duration of maturity for those particular instruments. They can invest both in the money markets, where in the money markets, that is a segment of the capital markets, where we will get traders or sellers and buyers of short-term instruments, while on both in the money markets and in long-term instruments. And then what does that give us? The clear differentiating item is that fund managers are not limited by virtue of horizon of the instruments that they can take up in their investments. And there is the issue of certainty or risk. And in terms of categorization of these two funds, money market funds and fixed income funds are generally categorized as low risk form of investment vehicles. But in terms of when you look at the kind of instruments that fund managers are able to take up for purposes of investment, and if we go by this second schedule, particularly the second item in terms of the crafting or creation of these investment products, in the mind of the fund manager, when crafting a money market fund, they are thinking of a low risk, short term oriented investor. While on the fixed income fund, crafting of that investment vehicle, in the mind of the fund manager, you are crafting a product for a low to medium risk and medium term oriented investor. And that means that under goal investing, money market funds are suitable for our short term goals, while the fixed income funds will be suitable for short to medium or generally our medium term goals. In terms of income generation, because passive income is one of the key things that investors will look at when creating or building their portfolios in these two investment vehicles. Money market funds crafted for short-term investing, ideally they are supposed to optimize the current or the existing rates of returns as measured by the treasury bills. That is to say that the benchmarking of the money market fund returns are purely based on the average, not what has been posted directly out of the auctions of the treasury bills, but the average returns of the 91-day treasury bills. So it's taking our posting what averagely, when you add up the rates that have been posted by treasury bills over a given period of time, over that duration, you take an average. That is what is used to benchmark the returns by the money market funds. And that goes to answer the question, why is it that we have a steep first decline in the returns by the 91-day treasury bill, which is at a low of 9.9% to date, and compared to the declining trend of the money market fund returns, averagely the rates by the money market fund returns are not coming down or declining at the same speed as the declining rate of the treasury bills. And the rationale or the reasoning is that the money market funds will not directly be affected by the immediate change by the treasury bill. Rather, by the change in the average. And the average rate will decline at a slower rate compared to the declining rate of the immediate treasury bill auctions. The other important thing on the same note on the averaging is that while the fixed income funds are able to take up bonds that have been issued for a long maturity periods, they can take up a bond of 5 years, they can take up an IFB of 20 years or 15 years. It means that the base or the minimum return on the fixed income funds is more guaranteed or is more permanent compared to the rates by the money market funds. The rates in the money market funds are meant to change at a rate that is higher than the change that should be posted by the fixed income fund. And that is why under differentiating or under the same schedule, item number 3, we say that for money market funds, we are looking at passive income creation, while on the fixed income funds, we are looking to generate a stable income source. So when you compare the two sources of passive income from the two investment vehicles, in the long term, the fixed income funds will give you a more stable income source compared to the passive incomes that come from the money market funds on the basis of their volatility. And lastly, money market funds are credited by the fact that they are highly liquid and by the nature of the assets to which these funds are invested into. While the same liquidity will not be realized when it comes to the fixed income funds by the virtue of purchases and disposal of units with the two platforms, because majorly a fund manager who is operating a fixed income fund and a money market fund, you will generally find that the characteristics or the attributes of the two investment vehicles are merely the same. Etica's money market fund require a minimum and a top-up of 100 shillings, and the same is what you will get in their fixed income fund. You can withdraw anytime that you want, you can invest anytime that you want. Those features are more or less the same. Kuza's money market fund require a minimum of 1,000 shillings and top up of the same amount. The same you will find with their fixed income fund. The investment or the withdrawals are just merely the same. The differentiating attributes of the two investment vehicles, as we have highlighted, are so marginal. But in essence, these two investment vehicles are that different. Therefore, while we go for money market funds because they are highly liquid, and for that reason, they are highly accepted as platforms for parking our cash awaiting disbursement to other investment vehicles or handling our emergency funds. While when you look at the fixed income funds, that they give you an opportunity to diversify. They give you an opportunity to spread your accumulated funds in the money market funds to different goals that you will have set. The two forms of investment vehicles are that protected because they are geared giving you an inflation beating returns, and for that reason of their low risk profiling, then they give you capital preservation. And that means that in these two investment vehicles, although not guaranteed, the structures that you cannot lose your capital at any given time. And so we will be looking at moderate to higher risk platforms. In those engagements, you will realize that there is a possible chance of losing a part, if not all, your capital in the investment because of the aggression and the nature of investments that take place in those investment vehicles. But for these two, a fixed income fund and a money market fund, they are structured in a way that you cannot lose your capital. And the last important schedule to look at is this schedule that compares the changes in the money market funds as compared to the current changes in the fixed income funds, in order to give you a pointer that it is the time that you need to start considering putting a part of your investment in the fixed income fund. And those are the only the funds that you would distribute or disperse to the fixed income fund. They are the ones that are targeting your medium term goals, or goals that you need to realize in 2 to 3 years. A short term period is up to 2 years, 1 to 2 years, or 2 years and below. Anything from 2 years to about 3 years, or sometimes we stretches to 5 years, that becomes a medium term goal. And anything beyond 5 years, that is a long term goal. And all these goals are supposed to be achieved or better realized in different investment vehicles. These investment vehicles are tailored to cater for different purposes. And therefore, it's now clear that your money market fund is suited for your short-term goals, your sinking funds, and your parking point. Your fixed income funds, those ones are geared towards your medium-term goals. Then we have the special funds and the other forms of investment vehicles that we shall be looking at that are geared towards taking care of your long-term goals. So with this schedule, we have taken these 9 fixed income funds or bond funds operated by different fund managers, and we have compared them with their corresponding money market funds. You will notice that in number 3, Zimele Fixed Income Fund, and number 8, NCBA Fixed Income Fund, on their side of money market funds. The money market funds we have highlighted in yellow color, and their changes are in red color, while the green, the light green and pink color, that one take care of the fixed income fund. So notice that for those two, Zimele and NCBA, they do not have the money market funds. And that is because, as we have handled in the previous reviews, these two fund managers commuted their investment and membership in the money market funds into a fixed income funds, and they no longer operate money market funds. But that said, then we have categorized or put in the order of their returns, starting with the one that is giving us the highest return, and we are comparing this with what these fund managers are giving in their money market funds, to realize that the key reason for this comparison is to send home the message that while money market funds over time get affected quicker by the changes happening or in the market rate, the fixed income funds take longer to absorb that effect, and that's why we say that they are more stable in the long term compared to the money market funds. So because medium-term goals and for purposes of income growth, the stability element of your passive incomes is very important. And as I said at the beginning of the video, is that this is the perfect time or a good time to bring out that message or information that fixed income funds give us that growth and stability compared to the money market funds. And this is a time because, as we notice or as we record their declining trend, which, as we have observed, is more gentle compared to the declining trend in the market interest rates. So looking at the KUSA fixed income fund, it has a rate of 15.49%. And KUSA's money market fund is giving us 15.94. Such a small difference. But to realize this change, KUSA's fixed income fund 15.49 was realized after that fund lost 5%. And the money market fund by KUSA also lost 1 basis point. So the changes are felt, but if you look at the fixed income funds in general, on the light green column, this is the fourth column, and the pink column. The light green column shows us the gain or the increase in the rates posted by the fixed income funds, in the month of December, end of month of December, as compared to the pink, the declining changes or the decrease in rates posted by other fixed income funds in the same category. And you notice that majority of the fixed income funds increased in their rates. The only one that posted the highest change was NABO's fixed income fund that lost 204 basis points, and that translates to losing 2.04% in their return. Most of these changes happen because of asset reallocation and probably maturing, the risk of reinvestment. Once the instruments that you are holding mature and you get in the market other instruments at lower rates, you are meant to face such changes. When you look at the money market funds in general, all money market funds that are operated by fund managers who are also operating fixed income funds, those money market funds lost in their returns. The highest loss was registered by NABO's money market fund and Orient Hifadhi money market fund, which lost 92 basis points. That is almost a 1% in their money market funds. And this is very important because if you look at the fund managers who are operating only money market funds, the effects are different from the comparison of fund managers who are running both money market funds and fixed income funds. And that is one of the important factors that you need to consider when you are choosing a money market fund or a fixed income fund. Does the fund manager operate the two? If the two are operated by the same fund managers, these are the kind of changes that you will be experiencing or spotting. And the good thing with holding a money market fund with the fund manager who has a corresponding fixed income fund is that in the event you notice this kind of alignment that the fixed income funds are picking up, and because of their stability, you will notice that it is not that the fixed income funds were giving us low returns as such in 2024, and that it's time that they are growing up or they are now noticing an increasing trend. No, the fixed income fund have been giving us fairly good returns in 2024, only that they have now posted their resilience in change. The rate of decline in their returns compared to the declining trend of the market interest rates, when you compare it to the money market funds are responding quicker to the changes compared to the fixed income funds. And that is where the stability of your income comes in. So it is easy to move your funds from a money market fund to a fixed income fund if you are investing with a fund manager who operates the two. But ideally to say, because these two investment vehicles give you almost the same features, if I were to shift my investments from the money market fund to a fixed income fund with the same fund manager, I don't lose that accessibility of the money, and therefore the aspect of emergency fund still remains. But as an advice from the channel is that you need to maintain certain amount or level of investment in the money market fund as you diversify other or a part of that investment to the fixed income funds. So a general is that fixed income funds give you a stable growth in your capital and stable, passive, consistent incomes in the times of stability. While money market funds, because of certainty and risk mitigation measure, they majorly attract a lot of investment by the fund managers when the economy is a bit unstable. When the economy is stabilized, most investment returns post growth and stability with the fixed income funds. In our next video, we shall be looking at Kuza's momentum fund before we analyze Manza's X. And for that reason, Kuza's momentum fund, because it has been requested heavily in our previous video, Kuza's momentum fund is more of a special fund, and that's why we want to feature it together with the OC fund and Manza's X for comparison purpose. Thank you for watching and meet in the next video.